Hey, hi. Yeah, today I think I wanted to share with you about the Fed's recent decision on the possibility of 50 basis point on the table, and even there is you know in the in one kind of like a meeting yesterday on Thursday. So yeah, something that you need to know, and they are saying about the front end loading, which is quite interesting, so that then they will do the 25-25 subsequently, to kind of like give it a more aggressive uh, slowdown in consumer demand, so that it kind of like gets closer to the supply, so that there won't be continuous price hike in all the consumer staples or consumer discretionary, or the upper echelon of consumer discretionary items like those branded goods or Teslas and all that. Yeah, so, and of course, the other thing is, of course, the another Fed uh, came up, and it's called James Bullard. He did mention as well that if they can even go as high as 75 basis points. What do we get from all this? Yeah, in the market, usually when you have all these Paul Volcker kind of aggressive rate hikes, right? It might create corporate earnings to go down because of high interest rates. As like, for example, uh, corporations, may be a factor in terms of their rise in their borrowing costs and all that, and it might create liquidity crunch, meaning, how to say, consumer were to slow down in spending because everything becomes more expensive. So with, let's say, $100, they can spend less right now. And then the third item is something called a credit crunch, especially in an environment where savings rates are low, and they start to go into credits in inflationary environment. Then the chances of all these credit defaults will become higher, and that's where the the likelihood of recession may come in. What I'm trying to tell you today is, or share with you today, is there are inflations happening right now, and but there's a lot of liquidity in the market. That's one thing you need to take note. And the second point is, there is no credit crunch issue at this point in time. In fact, the savings rate in China, likewise in US as well, people have not been spending on credits since 2020, 2021 as much as um, like during a normal inflationary environment, whereby people are borrowing to buy things. And it's not happening in this case right now. And then the third point, you kind of want to look at is unemployment, because these corporate earnings going down because of rising borrowing rates and all that. Unemployment may slow down and trigger more credit defaults and lower liquidity crisis. All these three kind of like are very common to create generate and a recession, and spiraling downwards of um, the economy and the stock market. But all these three currently, if you look at US, as I said before in my earlier episodes, they are actually the greater beneficiary in all these um, Russia-Ukraine war, by supplying fertilizer, oil, gas. Although the transportation part is an issue, um, weapons and all that as well. So there's no doesn't seem to have all these credit crunch, liquidity crisis, or even the unemployment starts to happen. Yeah, of course, people say that, they usually happen between now until 18 months for all this to set in. But I think we are not doing a Paul Volcker kind of aggressive rates hike that will create a counter-effective situation. So I just want to bring you to this video, which is quite interesting.
Bond market and whether it's actually connected to anything fundamental.
In the US had traveled 30 basis points up and down in the last 3 days on no major news. That is liquidity. And what you're seeing is that the deepest market in the world is having some, at the edges, liquidity strains. And we're seeing these outsized moves in yields. Now, people who've been in market for a long time are saying, keep an eye on this. This is interesting. Why, John? Because right now we've only talked about interest rate risk. We haven't talked about liquidity risk. We haven't talked about credit risk. All the focus has been on interest rate risk. And a really open question is, at what point does interest rate risk spill over into liquidity risk and credit risk? And that's something that we should be talking about much more and analyzing deeply.
Mohammed, let's do that now. What do you think is fueling that?
So I think the market is obsessed with interest rate risk right now, but growth is weakening. It is weakening all around the world, in the US, in Europe, in China. At some point, we're going to start wondering about credit risk. And then remember that you have a whole marketplace that has been conditioned by what remains very loose financial conditions. Let's remember that. Financial conditions, while the delta has been towards tightening, the absolute level for the US is still very loose. If that changes, which it will, if credit spreads move, if equity prices move more, and if rates stay where they are, if that changes, then you've got liquidity risk in play as well. So that's the sequence. John, I didn't want to be right on inflation. I didn't want to be right on the Fed being late. I don't want to be right on interest rate risk becoming also credit and liquidity risk, because then we are in a much messier situation than we are today.
Are there reasons to believe that you will be right on that? And what?
Yeah, so at this present moment, we don't have these three risks, so I believe the obsession with interest rates kind of risk is maybe, from my point of view, still a lot of overthinking, so as per my channel mission statement, think simple, don't get shaken by this volatile market. Overall, as mentioned just now, liquidity risk and credit risk, basically inflation are happening around the world. Who are the best country or market economy that can weather this storm amongst all this differentiate between the men's and the boys? I would still think that the US market is actually pretty strong. So yeah, thank you for listening, and hope you subscribe to my channel, and please like my video, and I'll put this link for you to read to watch the entire episode. Thank you very much.